Hey everyone, welcome back to Corporate Decoder. Today, GCL Global Holdings Ltd just filed its annual report on Form 20F, and I am seeing some serious red flags in its financials and outlook. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a massive loss this year, and its stock is trading below $1, putting it at risk of being kicked off the Nasdaq. And that is just the tip of the iceberg. So GCL Global Holdings Ltd is basically a video game, entertainment, and tech products company. They sell games, they publish games, and they also distribute hardware and accessories. They've been growing partly through acquisitions, like buying Ban Leong Technologies in 2025, which really boosted their hardware sales. Now, as you'd expect with a company like this, they face a ton of risks. Their success hinges on releasing hit game titles, which is always a gamble. They also rely heavily on partnerships with game publishers and third-party platforms like Steam, PlayStation, and Xbox. Changes in terms or fees from these platforms could really hurt them. Plus, the hardware side of things is super competitive and faces risks, like inventory becoming outdated quickly. And speaking of those publisher agreements, they often require minimum order quantities. If games don't sell as well as expected, GCL could actually lose money on those deals. They're also at the mercy of these big platforms, which can change their rules or pricing whenever they want. It is a tough business environment. Financially, things look pretty shaky for the year ended the 31st of March 2026. Their total revenue jumped to over $28 million, mostly thanks to that Ban Leong acquisition. But, and this is a big but, their cost of doing business also shot up, leading to a massive net loss of nearly $26.2 million. This is a huge change from the previous year when they actually made a profit of about $5 million. Let's look at that crucial number, net loss income. For the year ended the 31st of March 2026, it was a negative $26.2 million. Compare that to a positive $5 million in 2025. That is a swing of over $31 million. Yikes. Their revenue sources are broken down. The biggest chunk, over 96%, comes from selling console games, hardware, and accessories. Game publishing made up about 3.6%, and advertising services were less than 1%. So the hardware and game sales are really the engine here, but it is an engine that is currently running at a loss. And the cost of generating that revenue, it skyrocketed. For console games, hardware, and accessories, costs jumped by over 81% to about $209.9 million. This increase is directly tied to that Ban Leong acquisition, which brought in more sales, but also more costs. Even though revenue is up, their overall gross profit margin dropped significantly. It went from 15% in 2025 down to about 10.3% in 2026. This means they're making less profit on each dollar of sales. The hardware and accessories business actually saw its gross profit margin improve, thanks to Ban Leong's higher margins in that segment. But the game publishing side took a big hit. On top of the rising costs of goods, their operating expenses also ballooned. Selling and marketing costs nearly doubled, and general and administrative expenses more than doubled. A big part of this increase is due to the Ban Leong acquisition, but they also mentioned higher salary expenses and professional fees, likely related to integrating the new business and ongoing public company compliance. When you combine all these factors, the company went from a total segment profit of over $6.4 million in 2025 to a segment loss of nearly $6.3 million in 2026. The game publishing segment, which was a strong profit center last year, is now showing a loss of about $1.5 million. Looking at their cash flow, they used about $10.5 million in operating activities this year compared to using nearly the same amount last year. This means their core business operations are not generating cash and are actually consuming it. They did bring in a lot of cash from financing activities, over $46 million, mostly through bank loans and some investor money. As of the 31st of March 2026, they had about $39.3 million in cash equivalents, which sounds like a lot, but given their losses and ongoing expenses, it is something to watch closely. And speaking of debt, their current bank loans are over $21 million with another $32 million in non-current bank loans. The acquisition of Ban Leong was partly financed by a substantial HSBC term loan, and their variable interest rates mean they're exposed to rising interest rate risks. Now, here's a big one. The company received a notice from Nasdaq because the bid price of its ordinary shares fell below $1. They have a deadline to regain compliance or their securities could be delisted. Historically, about half of companies that do reverse splits to get back above $1 end up delisted anyway. Losing their Nasdaq listing would severely limit market access and make it harder to raise money. They've also got a share incentive plan which is standard, but it means they could issue more shares, potentially diluting existing shareholders. And here's something for the risk takers: they don't expect to pay dividends anytime soon. planning to reinvest all earnings back into the business. Looking at the balance sheet, their liabilities have grown significantly. Total liabilities are over $142 million in 2026, up from about $64 million in 2025. A big chunk of this is due to the increased bank loans and other payables. This brings their total liabilities to over $142 million against total assets of about $183 million. While they technically have more assets than liabilities, that shrinking shareholder equity, especially the negative retained earnings, is concerning. They are reporting material weaknesses in their internal controls over financial reporting. This means their accounting processes aren't as robust as they should be, which can lead to errors or misstatements. This is a big deal for investor confidence. The financials here paint a picture of a company struggling with profitability despite revenue growth. The jump in revenue is clearly driven by acquisitions, but the costs associated with those acquisitions and the core business are outpacing the gains. Leadership-wise, Jackie Chu-Si-Wee, the group chairman, seems to hold a lot of power, controlling a significant portion of the voting shares. This means the company is considered a controlled company, which allows them to use certain exemptions from Nasdaq's corporate governance rules. This can mean less independent oversight for shareholders. As a foreign private issuer and an emerging growth company, GCL Global also has reduced disclosure and governance requirements. While this can streamline operations, it also means investors might have less protection. Ultimately, the story here is one of rapid expansion through acquisition, leading to significant revenue growth, but also a dramatic increase in costs and a substantial net loss. The delisting risk from Nasdaq is a major immediate concern, and the material weaknesses in internal controls add another layer of risk. They have a lot of debt and are burning through cash. My biggest concern is whether they can actually turn this ship around and achieve profitability before their cash runs out or they get delisted. What I am actually looking for is a clear path to sustainable profits and a strong plan to address those internal control issues. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord linked in the description.